Get Rich Education is brought to you by Narada Real Estate, the Real Asset Investor, and Highlands Residential Mortgage.
Are you on track to achieve your financial goals? Income-producing real estate is the most historically proven way to accumulate wealth and has created more financial freedom than any other means. Norada Real Estate provides everything you need to invest in the best turnkey cash flow rental properties. Our simple, proven system will help you create real wealth and passive monthly income. Get your free strategy session with our knowledgeable investment counselors at noradarealestate.com. That's Norada realestate.com.
Welcome to Get Rich Education with Keith Weinhold, giving you information and ideas on the investment that has turned more ordinary people into millionaires and billionaires than anything else, and can provide you with more wealth and happiness than you ever thought possible. Now, here's your host, investor, entrepreneur, business owner, and educator, Keith Weinhold.
Welcome to Get Rich Education, episode 134. Hi, I'm your host, Keith Weinhold, helping you build wealth where we're heard across 179 world nations. Today, we're going to talk about how you can specifically reduce your taxes this year and maybe even legally make your tax liability zero this year. Get Rich Education is not the show for you if you're looking to save money by using cloth napkins and rewashing them over and over to try to save pennies or some zero impact nonsense like that. You've got to be kidding me. Don't be a conformer. If you want to be a conformer and do what everyone else does, you're not going to get any more than what everyone else has. That's why we've got some mantras on this show that I've been, echoing from the beginning. You are now in the land of financially free beats debt-free. The scarcity mentality is abundant and the abundance mentality is scarce, and compound interest is lame. It won't build wealth. Leverage is what's powerful, and don't follow money. Make money follow you. Following money around to jobs can be tiring or even downright oppressive sometimes. Instead, make money follow you with cash flowing real estate in multiple markets. It doesn't matter where you live, those passive income cash flow deposits from your property manager follow you, and the people that live in your turnkey rental homes, they're the ones following money. And then it is vital to do the right thing before you do things right. And finally, there's don't live below your means, expand your means. That one's not mine. That's a mantra that the Rich Dad Company is credited with, but it guides me in the way that I make decisions in life. Don't live below your means when you could just as well use those same energies to expand your means. A rich man digs for gold. A poor man is concerned with the cost of a shovel. But see, we don't mind cutting expenses when that expense is taxes. Because when you pay more in taxes, that doesn't do anything to improve your quality of life. And taxes have been around for centuries, and even long before Benjamin Franklin famously said, "In this world, nothing can be said to be certain except death and taxes." Maybe I've got Ben on the mind because today I'm in the same state that Ben called home. I'm here in Pennsylvania. Many ancient civilizations collected taxes. In the years 2000, 3000 BC in Egypt, citizens were required to pay taxes to the pharaoh. Tax collectors were known as scribes that evaluated each citizen's harvested crop to determine the amount of taxes that were due. Egyptian citizens who didn't pay their tax or filed their taxes inaccurately could be flogged or even executed. In ancient China, emperors imposed heavy taxes that during the imperial period of about 2000 BC all the way up to the Chinese Revolution of 1911, and tax revenues financed the Great Wall of China. And then in the 1700s, the United States and Britain had major conflict over Britain exacting taxes on the U.S. Britain taxed the 13 American colonies on things like sugar, stamps, and tea. That's when the colonies were crying, "No taxation without representation." You probably remember that from junior high history class, because Americans didn't have a right to vote over in the British Parliament. Yet for Britain, they thought it was okay to impose taxes on the colonies then, and that led up to the American Revolution and the very formation of the United States. I'm going to ask today's guest to give us just a little more history with where we got today with taxes, but we're going to focus today mostly on how you can classify real estate repairs versus improvements in order to reduce your taxes as much as you possibly can. And then we're going to talk about what a disaster 401ks are. Today, we have a flat-out tax genius on the show. You likely already know who he is because he's a regular contributor here at Get Rich Education. He's the founder and visionary of Provision Wealth, based in Tempe, Arizona, the top tax planning firm on the planet. His firm handles the taxes for Robert Kiyosaki and for, well, me and my wife, among other clients. He and I are each contributing writers to the Rich Dad Advisors blog. We write articles alongside each other there at richdadadvisors.com, and he's the best-selling author of the book Tax-Free Wealth, which is, frankly, the only tax book that I have ever read from cover to cover, because he does have the unique ability to make something like taxes interesting, fun, exciting. He's also the creator of a great newly created video module called Tax-Free Formula, which our Get Rich Education newsletter subscribers here already know about. Welcome back to Get Rich Education, Rich Dad Advisor Tom Wheelwright.
Hey, thanks so much, Keith. Always good to be on the show.
Yeah, it's so good to have you back. Tom, before you came on, I was just giving my audience just a really brief history of taxation and just how we got to this point, with a little history of taxes in Egypt, China, and the U.S. versus Britain in the 1700s. What's happened since then with taxation and tax laws?
Well, obviously, we didn't have an income tax in the U.S. The income tax historically has been for times of war. And we got the 16th Amendment in, 1913, 1914. And that made it permanent, basically, the income tax in the U.S. And that's about the time that the other countries around the world, they started making their income taxes permanent as well. It didn't apply to employees until 1944. And in 1944, it started to apply to employees. Before that, it had only applied to business owners and investors. And that was a big switch, because what's happened since then, of course, is that the income tax has become a favorite of business owners and investors, and it's become a real burden on employees. So employees are the ones, those with the W-2s are the ones that get hit the hardest now, when prior to 1944, they weren't hit at all. And even in 1944, the idea was that the personal exemption, if you look at your personal exemption, then that amount was supposed to be enough to exempt the income of the average wage earner. So it was equal to the average wage of the average person in the U.S. when it was initially enacted. Now, of course, it's just a drop in the bucket. So it's certainly gotten a lot more complex. We've had a few major tax acts. And last one was in 1986, when I was in Washington, D.C., and Ronald Reagan was president. And that was the last time the tax law was overhauled. And at the time, what happened is that they eliminated a lot of tax benefits, the biggest one being as any real estate investor knows, the passive loss rules. And so they broadened the base and they reduced the rates, the number of rates, and they reduced the overall rates. Of course, since then, the challenge with broadening a base is that it's really easy to raise rates at that point, and it generates a lot of income. And so that's what's happened. Now we're back to an enormous number of rates in our progressive tax system, topping out at over 40% when you add in the Obamacare tax. And on top of that, the states have their own income taxes, and they're complex. California now, a California tax return is typically more complicated than a federal tax return. And it's just amazing. California is a big economy, fifth largest economy in the world. And so it's just gotten more and more complicated, and I get asked all the time, will it ever get simpler? And the answer is no, it won't. And the reason is because what the governments around the world, and started in the U.S., but the governments around the world learned beginning in the 1960s just how much people hated paying income tax, and that a small incentive would go a long ways to getting them to change their behavior. And so the tax law now is primarily a way to get people to change their behavior. The most, I think, infamous of those is the 401k. Okay, and the 401k is a behavior that people would never undertake that behavior if it were not for the tax benefit associated with it. And it's true with, many other things. I mean, if you want to, the government wants you to send your kids to college, so what do? They give you a tax credit. They want you to buy a house. They give you a tax benefit for owning a house, but no tax benefit for renting a house. So therefore, it's much better to own a house from a tax standpoint. And those are a couple of the biggest tax incentives we have. Actually, the biggest tax incentive in the U.S. is the exclusion from income for health insurance provided by an employer. That is the single biggest item. In fact, it's bigger than all of the corporate exclusions combined, is the exclusion for health insurance. And all it is, it's an incentive for employers to provide health insurance to their employees. And so that's really where the tax law is now. Frankly, I don't see that changing.
Yeah, it is enormously complex. So the government goes ahead and disincentivizes those behaviors that they do not want their citizens to partake in. And we might think of what some people call sin taxes on something like alcohol or cigarettes. And then you touched on it, the government incentivizes the behavior that they want us to engage in because that they know that the health of our citizenry is good for our economy and for the well-being of our nation. And that's also why the government incentivizes things like agriculture and food and energy and, of course, our favorite one, housing. And tax code has become so enormously complex. Some people might call it punitive if they're really paying a lot in taxes. But, us as real estate investors, we've done something so that we can go ahead and get control of our taxes when we go ahead and purchase property. And Tom, my listeners are so used to hearing me say it. My mission is to provide housing that's clean, safe, affordable, and functional. Do good in society. And you will be rewarded for it with both cash flow and through government tax incentives. And one of those ways that we can do that, the way we can really take control when we buy and hold for the long term, which is what we do here, typically we have turnkey real estate that's renovated, so we don't have very many repairs or improvements to a property in the early years. But as time goes on, since this is long-term buy and hold, we do have a number of those expenses, some of which are categorized as, I'm going to call repairs, and others as improvements. So do you want to talk about how us as real estate investors can take control of that and get the maximum tax advantages off repairs and improvements, and just talk about the difference between those a bit, Tom?
Yeah, this is a big deal, Keith. And I find that very few real estate investors and their accountants understand just how big a deal this is. A few years ago, we got new regulations from the Treasury that are very clear, I think. And I've read them many, many times. I read them probably 2 or 3 times a year. I'll read all the way through these regulations because they provide really good guidance on what's a repair that we currently expense and what we have to capitalize. And first of all, let me talk about why it's important. It's obvious maybe that, well, if it's a repair, then it's expensed. And we'd like more expenses this year because it reduces our taxable income.
Right. So where we can, we want to try to call things, whenever it's legal and possible, a repair rather than an improvement, since an improvement only helps our taxes incrementally a little bit each year over time, and a repair is where we can make that complete deduction in that same tax year that the repair took place.
Yeah, not only that, but let's say down the road you decide to sell the property and for some odd reason you don't do a 1031 exchange, then if you've capitalized that as improvement, you have recapture on that. If you deduct it as repair, you don't have recapture.
Good point.
So it's a very big difference, both in the short run and the long run. There's 2 rules that I think everybody should be aware of. The first actually is one that is not talked about much, and it is the $2,500 rule. And the $2,500 rule says that any individual item that costs less than $2,500 can be expensed. So it doesn't matter, dishwashers, refrigerators, hookups, anything that individual item is under $2,500 on the invoice is deductible as a de minimis rule is what they call it. You have to make an election on your tax return. But my experience is that, boy, especially when you're talking about single family homes, that's about 90% of what you do. I can't imagine much unless you're adding a garage or you're adding a new wing or something like that. You're probably going to be under $2,500 for each individual item. I mean, carpet, typically you're under $2,500. So you don't even have to think about whether it's repair.
Right. So we're talking about things like replacing the air conditioning unit, if that's under $2,500, maybe the water heater, another item that's going to be under $2,500. That entire thing can be called a repair and deducted where the investor gets that benefit in that same year.
Right. I mean, it's actually just deducted as an expense. Yeah. I mean, we can call it a repair. We can just call it as it's under the de minimis. So as long as it's under $2,500, we're good. And by the way, that doesn't mean that you can take your general contractor who bills you $30,000 and break up his bill into $2,500 increments. It does not work that way. Right?
Okay,
that
right.
is a $30,000 bill that you're paying $2,500 at a time. That's different.
Right.
It really literally has to be an item that's under $2,500. Just want to be clear. Let's say that you're talking about stuff that's more than $2,500. Well, then what you have to look at is what is the nature of what you're doing? And I think the easiest way to put it is if you are putting your property back into the condition that it was when you originally bought it, or back in the condition that you originally placed in service, after you did your initial improvements, that's a repair. As a general rule, that's going to be a repair. There are some technical rules about, you're going to do it twice in 10 years, and et cetera, et cetera. But the reality is when you're looking at things like you're turning a property, so you're looking at carpet, paint, just sprucing it up, that's all going to be repair. Now, it's going to be different in the year you buy it. So I'm glad to hear, Keith. You're providing a turnkey property. So they're not going to have that initial question of they go in and buy a rundown property and that initial work, that's a little more complicated. But if you buy it in good condition in the first place, and then every few years you're going to have new carpet, you're going to have to paint, you're going to have to do things to it, that's pretty much all going to be repairs. So that's not even an issue. Now, if you do a major renovation, they call it, the term the regulations use is a betterment. And so it's really, are you actually improving? Is it making it better? Are you doing something that's going to create more income? For example, a good one would be adding a garage. That would be an improvement. That would be something you would capitalize. But let's say you're taking a den and converting it to a bedroom. I think that's a repair. It's pretty tough in my mind to say that that's really a betterment. You haven't done that much. They do have a rule in the regulations about how much you have to do. Okay, so you kind of have to look at, is this a significant change? And they use an example. There's lots of examples in these regulations, and one of the examples uses 10%. So it's clearly, if you're not improving at more than 10%, clearly that's a repair. I mean, unless you're adding a separate building, or, if you add a little mother-in-law's unit onto it or something like that, that's probably going to be capitalized as a betterment. But most of what you do on a single-family home like that, most of it's actually going to be a repair. So you replace the toilet, you replace the cabinets, to bring it up to snuff. Now, if you take one and you go, wow, this is a $100,000 home, we're going to turn it into a $250,000 home, you probably have some items that need to be capitalized there, because it's like, the way I look at it, if you took a Class B space and turned it into a Class A space, that's going to be capitalized. But if you turn a Class B space into a Class B plus space, probably repairs.
Now, what about something that might, I guess, straddle maybe some definitions of the two? Let's say, for example, someone replaces a roof. Well, that probably costs more than $2,500, but yet you can't get more rent for that because oftentimes a tenant might not even know you replaced the roof. They just expect to have a non-leaky roof. So I would think that would be capitalized as an improvement over time, a.k.a. a betterment.
But it's not.
It's not.
It's not. It's a repair. Unless you take the entire roof off, which nobody does, you're really replacing the shingles and the stuff on top of the roof. I don't know that I've ever seen a roof actually replaced.
Right.
But what you're doing is you're putting it back into the condition of when you bought it. So you're not making it better than it was when you first rented it out, because it already had a roof and the roof didn't leak and it worked. And now what you're doing is you're replacing that, and now the roof still doesn't leak. Okay? That's a repair.
Yeah.
That would be $25,000, $30,000. It's still a repair.
Wow, that's interesting. So that's good news. That whole thing then can be expensed and deducted, if you qualify, in the same year. Why don't you give us another example of what's a repair versus an improvement? And this is enlightening to me too, Tom. I didn't even know about the $2,500 rule before we started talking here.
That's why I say most people don't. Another one that, actually, here's a good one, and this is not single-family homes. I think what is a really interesting planning idea. Let's say that you own a commercial building and that your business leases a space in that commercial building. It's proportionate. So if you go in as the tenant and you do all these leasehold improvements, you are improving 100% of your space. But if you're a landlord and you go in and you do all the TI work on 1 out of 10 units, that's only 10%. That's going to be a repair. So it depends on who does the work. If the landlord does it, it may be repairs, whereas if the tenant does it, it's probably capitalized. Of course, I have many of my clients in the real estate business, investment business, and some of them are very big apartment housing landlords. And we have literally over the last couple of years since these regulations came out, we've saved clients millions and millions of dollars because of the repair regs and understanding them. So this is an area where it's really worthwhile to sit down with your CPA, make sure that they understand the repair regs. And if you want to give them what the regs are, it's the 263A regs. That's what they're called. And it's actually 263A-3 for you code heads out there. That's what we call people who actually know the code sections. Absolutely. This is something that's worth, if you have any significant real estate ownership, it is worth sitting down with your CPA and looking at, is it a repair or is it capitalized? Because we had one this year, I just filed, and this guy never had anybody to look at his real estate before. They're a new client. And, just picking up the $2,500, we picked up $35,000 of deductions that his books he'd capitalized.
Wow.
I've got 2 K1s this year from a company that does large real estate projects that I consult with. And these K1s are showing $1 million or more in losses. And they're from the repairs. They're not real losses, right? They're actually improving the property, but they're expensing it. And this is a chance, if you're paying taxes, this is a chance to not pay tax.
I think you can start to get an idea of why my wife and I use Tom in ProVision to do our taxes. There are so many layers of complexities there, and he just gave an example with the commercial building there where it even makes a difference upon who does the improvement as to the way that it's treated for tax purposes, whether it's the tenant or whether it's the owner that does it. Tom and I are going to come back after the break and talk about 401ks and what a disaster they are. You're listening to Get Rich Education. Our guest is Rich Dad Advisor Tom Wheelwright. I'm your host, Keith Weinhold. Are you looking to invest in your first investment property or grow your existing inventory? Highlands Residential Mortgage can help, offering down payments as low as 15% and credit score requirements down to 620. Their streamlined process is designed to help investors close their loans quickly and without any surprises. You need someone who knows cash flowing real estate and can help guide you through the muddy waters of today's lending environment. So call Graham Parham today, toll free at 855-326-6802. The Parham team can help you purchase or refinance any of your 1 to 4 family investment properties.
NMLS number 195724, 12001 North Central Expressway, Suite 750, Dallas, Texas 75243. Equal housing lender, not licensed in all states.
As a lot of investors know, multifamily real estate has been one of the best asset classes to be invested in most of the last decade. While the great deals have been harder to find lately, there are still opportunities in select markets where savvy investors can get lots of appreciation and strong cash flow if you have a great team. Dave Zook, founder and president of The Real Asset Investor, and his team have been very active in the multifamily space in Memphis, Tennessee. On the heels of the Great Recession of 2009, Dave and his team quietly started acquiring multifamily assets, and in the last few years, he has syndicated over 2,000 apartment units, creating strong cash flow streams and big appreciation for lots of their investors. It's not too late to get involved. If you're an accredited investor and you would like to learn more about investing in great multifamily apartments with a world-class team, email Dave and his team at info@therealassetinvestor.com.
This is our Rich Dad, Poor Dad author, Robert Kiyosaki. Listen to Get Rich Education with Keith Weinhold. Don't quit your daydream.
Welcome back to Get Rich Education with our guest, Rich Dad tax advisor Tom Wheelwright. So, Tom, I've talked about on the show before about how maybe people aren't looking at 401ks in the big picture 40,000-foot view like they should, and they're so concerned with taxes and what's going to defer taxes for the short term. I'd just like to get your insight on some thoughts that you have on the 401k and just what it does with someone's cash flow over their life and what it does with their tax considerations throughout their life. Because I know you've been on the show here before and you said basically anyone that's all in on a 401k, a lot of times that person has their head in the sand. So what are your thoughts?
Depends on, frankly, what's your investment strategy? What do you want to do with your money and how educated do you want to get? I think for people who do not want to be educated about their investments and do not want to be involved in their investments, maybe the 401k is the best thing for them.
Yeah.
Because, it's really kind of a brainless activity. Give your money to somebody else and say, you go invest it and, let me know what happens. And, you're basically giving somebody else responsibility, but remember that it's your money. So if you're interested in your money, if you're interested in being actively involved in your money, then a 401k makes absolutely no sense whatsoever, because I think everybody should understand is that when you talk about a 401k or an IRA or a pension plan or a private sharing plan, and again, it doesn't matter if you're in the U.S. or it doesn't really matter where you are, what you're doing there is you're in what's called a qualified plan, which means that the government is regulating you and they are scrutinizing you very carefully. And they're telling you how much money you can put in. They're telling you what you can invest in. They're telling you when you can pull the money out. They're telling you what tax rate you have to pay when you pull the money out. They're telling you everything that you can do all along the way. So it's really a government controlled, you call it a government qualified, but it's really a government controlled retirement plan. And if you're good with that, if you're good with the government controlling your life, then I think 401k is great. But if you look at the rich and what the rich do, they don't have 401ks. They don't have pension plans. What the rich do is they invest in what we call a non-qualified plan, which means the government is not looking at you. So that means that they have their LLCs that are investing in real estate, or they're investing in businesses, or, the oil and gas or whatever, but they are not doing it inside a qualified plan because they don't want the restrictions. There's so many things we can do. And the other part of this, Keith, that we were talking about on the break is that the challenge is, do you want to postpone your tax or do you want to eliminate your tax?
Right.
And I think that's the key issue here from a tax standpoint. If you want to postpone your tax, then 401k is great. It's a great way to postpone your tax, as long, of course, as you don't mind investing in those few types of assets that you're allowed to invest in a 401k. On the other hand, if you want to eliminate your taxes, we were just talking about repairs and you're eliminating taxes. You never have to recapture those taxes. They're gone forever. If you're doing a plan where you're going to continue to invest in real estate for a lifetime and you're doing like-kind exchanges, 1031s, you're never paying tax. When you die, the tax goes away. So we call defer until you die. I think we've talked about that on the show before. And again, you're eliminating your tax. With a 401k, not only can you not take it out until you're 59 and a half, but once you turn 70 and a half, you have to take it out and you have to be taxed on it. I was on radio not too long ago, and one of the questions that was asked was, what about investing in real estate through an IRA? And I'm going, that is the dumbest idea ever. I know I'm not pulling a punch here, and I know people will argue with me all day long, but I just see no good idea. If you're going to use debt, which is the whole reason you invest in real estate, right? The point of real estate is debt.
To get that leverage.
To get those high returns.
Sure.
The real estate's really not any better than any other investment without the debt. Okay. And you're going to pay tax on your income as well. You're not going to have the depreciation that you get when you have leverage, when you have debt. So you can't do that in an IRA. You can't get that same leverage. And you lose all the tax benefits. All the tax benefits of real estate you lose inside an IRA. So why would you give up the best tax benefits in the world are real estate in every country? And why would you give that up to do it in an IRA because you want to avoid a 10% penalty? I just don't understand. It's 10%. You're going, yeah, but I have to pay tax. You're going to have to pay tax anyway.
Right.
Paying tax, it's not your money. Okay. This is one thing that I think people don't understand about a 401k. They go, well, my 401k is now like $600,000. I'm going, no, it's not. It's $600,000 minus your liability to the government. That's what it is. People always mistake that. They go, well, if I pull it out, I have to pay tax. So you're never going to pull it out? You're always going to have to pay tax when you pull it out. And if it grows in that 401k, guess what? That tax gets bigger and bigger and bigger. Of course the government wants you to put money into a 401k. Of course they want your employer to match. This is the other thing I get all the time, Keith, is, yeah, but my employer matches. Okay, so we've done the calculation. If you have an employer match, after 30 years, that employer match is worth less than 2%. That's how much it's worth, less than 2% over 30 years, that employer match.
If it's a dollar per dollar employer match?
It's a dollar for dollar employer match. It's worth less than 2% increased return on your investment. And I'm going, okay, so you're investing at 3%, and now it's worth 5%. But even a triple net lease will get you 12%, with the leverage. So why would you do that? Plus, you're paying taxes on it. I'm sorry, it just makes no sense to me.
Yeah, wow, that's really interesting stuff. Oh, there's just so much to comment on there. Like you were saying earlier, no one ever says, I wish the government had more control over my life. But a lot of those same people are investing in 401ks, 457s, and similar plans. And yeah, why simply defer tax when you could eliminate it or get it very close to elimination with real estate? And boy, the other big thing that we haven't even touched on, Tom, with 401ks is, when 401ks were kind of being rolled out and starting to come of age in the early 80s, they were actually known, like their employers in the documentation in the literature to their employees, those plans were known as salary reduction plans. Okay, right. That's what 401ks were called, but they couldn't get enough participation in them with that name. So they soon scrapped the name, salary reduction plan. But, principally, I contend that that's what 401ks still do to a person. And that's the greatest impact in their life beyond taxes. There's zero cash flow plans until they're at least age 59 and a half. So why opt in for a salary reduction plan when you could opt in to a salary increase plan, which is what something like cash flowing real estate is?
I agree. And I think everybody ought to have a retirement plan. I just would like one that's not controlled by the government.
Right.
I'd like to be able to control my own retirement plan. Thank you very much, government. And thank you very much, Wall Street. I think I know how to handle my money better than you do. And of course, if you think Wall Street knows more about how to handle your money, then maybe you should give it to Wall Street. I think that's the big Wall Street lie. The big Wall Street lie is you're too stupid to handle your own money. So you need to turn it over to us because we're smart and you're not. And that's just, it's offensive and it's a lie. And there's not one person I've ever met who can't do a better job than Wall Street with their money, who doesn't have severe mental challenges. If you've got your facilities and you're willing to learn, I've done real estate, Keith, for so long. My parents did real estate. It's just not rocket science. It's just not that hard. You invest for cash flow. You don't invest for appreciation. You invest for cash flow. You make sure that you've always got a tenant in there. You pay attention to the tenant. You're nice to the tenant. And life is good. It's like a business, you got to take care of your employees in a business. You got to take care of your tenants when you're in real estate.
Any other thoughts on 401ks and opportunities missed when someone diverts so much of their income into a salary reduction plan like a 401k, Tom?
I talk about this in my book, Tax-Free Wealth, is that when you look at investing, look at your after-tax return on investment, because so many people look at before-tax returns. And I point out an example in my book where you can have a before-tax return in real estate that's, say, 8%, and an after-tax return that's 10%. Real estate's really one of the few investments where you can have an after-tax return that's greater than your before-tax return because of what we'd call phantom income. That's taxes that you're not paying on other income, like your employee income or your business income. You can actually increase your rate of return with the tax law. If you're in the stock market, though, you're always going to pay tax. There's no way to eliminate your tax. So even let's say that you're in a 9% stock portfolio that's producing 9%, but you got a real estate portfolio producing 8%. But the stock portfolio, you have to pay 25% tax on. Well, now your return goes from 9% down to 6.5%. So you have not a comparison of 8% real estate to 9% stock. You have a comparison of 6.5% stock to 10% real estate. So you got this huge gap, and it happens because of taxes. So you have to include the tax consequence into your decision-making process.
Yeah, that's a great point. Wow, I never thought of it that way. So your after-tax return with something like real estate can be greater than your before-tax return, where typically that number is almost always lesser.
That's exactly right. And that's one of the primary reasons I would not put real estate into an IRA, because you lose that benefit in an IRA.
Yeah, that's a great thought. Well, a lot of this really comes down to real estate investors, getting the right guidance. And I sure don't know all these tax rules. I've done a fair bit of learning myself today, Tom. So what can really somebody do when they're out there looking for the best tax advisor? What are some questions to ask? And what are some red flags that you might be dealing with a tax advisor you want to avoid?
Well, the biggest red flag is that they're afraid of the IRS. So If they say, don't take a home office deduction because it raises a red flag, or, don't take your automobile deduction because it raises a red flag, or, they point out these red flags that are legitimate deductions. I'm not saying take deductions that aren't legitimate, okay? I would never do that. I mean, we want to do everything legal, square within the law. But that's one of the things that, if they're afraid of the IRS, then that's pretty sad, because you got to think when somebody comes out of school and they've got a master's degree in tax, I don't think the first place they're looking for a job is the IRS. The one place where you can get a job and your customers despise the sight or the sound of you. Nobody wants to do that job. That's a job that you take when you can't get a job somewhere else. Well, if your advisor is afraid of that person, that's pretty sad. I mean, frankly. So that would be the number one. Okay, they're afraid of an audit. They shouldn't want an audit. Nobody wants an audit. That's a waste of money and time. But you certainly shouldn't be afraid of one. The other thing is the same way I look at a physician. If I go to a physician, I judge a physician by the questions he asks or she asks me. If they're asking me good questions and they're really getting to my health and they're getting to doing a good diagnosis, it's pretty easy to tell. And they're spending a lot of time in that diagnosing process. And Keith, you work with us. We spend a lot of time in that diagnosis area because you as the taxpayer, you have all the answers. It's up to your advisor to ask the questions. That's not really your job. Your job is to give the answers to the questions your advisor asks. And then once the advisor asks the right amount of questions, then they can start saying, okay, this is what you want to do, and this is where you are, and this is how you earn your income, and this is how you spend your income, et cetera, et cetera. Here are some options of things you can do. That's another thing that I would be looking at is how much time does the advisor spend diagnosing your situation and asking you questions? And are they looking at the big picture? People ask the question, well, is this deductible? The wrong question. I mean, frankly, it's the wrong question. The question is, how do I make this deductible?
Right.
Because everything can be deductible in the right situations. And so what you get is you get somebody saying, well, it depends. I'm sorry, I think that's a cop-out answer. It depends on what? So instead, I always say that advisors can do or can't do. This is what you can do or this is what you can't do. Stay away from the can't do people because you don't need to know what you can't do. You only need to know how to do what you want to do. By the way, so in my book, Tax-Free Wealth, Chapter 23 is all about how to find a good tax advisor. And if you go to my website, taxfreewealthadvisor.com, you can get a free copy of Chapter 23 on how to find a good tax advisor. So you don't even have to spend $9.99 on Amazon to buy the whole book if all you want is a good tax advisor. But I do recommend, of course, Tax-Free Wealth just because I think my experience is that the person who has the most control over your taxes is you. It's not going to be me, your tax advisor. It's going to be you, the taxpayer, because you're taking action every single day that will reduce your taxes.
Yeah, that's right. And when you brought my wife and I on as clients several years ago, that was one of the first things your firm did. You really took the time to get to know us. What are our ambitions? What's in our portfolio now where one thing might offset another for tax purposes? And also, what do we plan to invest in next? And that really helped steer us. So, Tom, I think you already went ahead and gave out your resources. Your great book, the best tax book I've ever read, is called Tax-Free Wealth. And your website is taxfreewealthadvisor.com.
That's it. Those are the best resources I know of.
Tom, thanks so much for coming back onto the show.
Anytime, Keith. It's always good to be with you.
Oh man, such good stuff today. Once again, boom goes the knowledge dynamite from Tom Wheelwright. Yeah, I did some learning today, like about the $2,500 threshold. That's basically the border, the cutoff. Below that mark is what you can call a repair that you write off in the same year. Above that is where you must capitalize it over time, over a period of years. No wonder I have Tom's firm Provision steering me as they provide both my tax strategy and they do my actual tax preparation every year. Today was Tom's record 6th time on the show, and boy, he said some things today in a way I've never heard before, like how utilizing 401ks means that the government has more control over your life. I think that's something that we all knew, but we just don't often think about it in those exact terms. Yeah, if you don't care about your financial future, then okay, go ahead, max out a 401k plan. But if you do care about your future, well, I guess that's why you're here. At last check, Tom's new video course was closed to new students, but to find out when that opens again, just subscribe to our free newsletter at getricheducation.com. And our free newsletter also has tons of actionable real estate investment opportunities from the best providers in investor advantage metro markets. Again, that free newsletter is right there for you at getricheducation.com. You can subscribe to it there. And to engage with Tom Wheelwright and his team now, go to his site, taxfreewealthadvisor.com. Next week, we're going to talk to an investor that's owned over 2,000 single-family income properties and apartment units. Until then, I'm your host, Keith Weinhold, and I appreciate you so very much. So I want you to live an abundant week and don't quit your daydream.
You've been listening to Get Rich Education, telling you what the wealthy won't tell you about real estate and investing.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
Cash flow real estate investors nationwide and worldwide, this is Get Rich Education's Keith Weinhold. Forbes has rated Memphis, Tennessee as the #1 cash flowing market in the world. Our good friends at Mid-South Homebuyers have been Memphis's premier turnkey real estate provider for 14 years with a stellar reputation and an A+ rating with the Better Business Bureau. Owner Terry Kerr was born and raised in Memphis. Yeah, he knows the market and has renovated and sold over 1,000 houses in the Memphis area. Find out what their many repeat buyers already know. Their houses are completely renovated, even come with a 1-year builder's warranty and a lifelong rental guarantee. They're a perfect fit for the first-time out-of-state investor or the seasoned investor diversifying their portfolio. Mid-South Homebuyers' friendly staff makes investing easy. Learn more at midsouthhomebuyers.com or give them a call at 901-217-HOME. The preceding program was brought to you by your home for wealth building, GetRichEducation.com.